Hi, and welcome to Sunday Night Charts. We take a look at the charts to help you with the trading week ahead. I'm your host, Steve Van Meter. In today's episode, we have some new data that we're adding from the my momentum screener that we talked about briefly in the Friday show. So we're going to add some new data points to perhaps help you out and give you a better idea that momentum is one of the few things out there that can not only predict prices, it helps you set the direction of where prices are going to go. It can also be a form of technical analysis. It's really cool. Not many people understand that, though. Trend indicators, short-term 9 days, intermediate-term 21, long-term 50, and ultra-long-term 100. Moving averages, these are the colors on my screen. 50 days in green, 100 days in blue, 200 days in tan. Price is the general direction prices are headed. Obviously, that's the easiest thing to figure out. Momentum is the rate of change, and a bullish indicator for both is positive, and a bearish indicator for both is negative. Momentum often, but not always, leads price. Technical analysis attempts to determine where buyers and sellers are at. Resistance is a level buyers can't break, and support is a level sellers can't break, or resistance is where sellers are at and support is where buyers are at. Technical analysis does not predict prices. Contrary to popular belief, it can be used to determine the risk of a trade, help with timing of trade, and provide direction to the path of least resistance. Charting offers possibilities, not probabilities, and not certainties. Let's get into the S&P 500. And there's only one change. We notice that price remains bullish. Everyone around the world is super bullish on U.S. equities to the point where we have market cap to GDP, I believe, beyond the all-time highs. So making new all-time highs as investors heavily bet that the U.S. economy is going to come rebounding back stronger than it has been at any point during the last 10 years of this expansion. The annual momentum, though, if we look at short and medium term, still bearish, long term flipped over slightly to bullish. But looking at these new indicators, we have 3-month momentum, 6-month, and 9-month momentum. All are green, meaning they're all positive. And when you see momentum start to flip negative on the 3-month, and then 6, and then 9, and then eventually on the 12-month momentum, which I couldn't really fit in here and make it look correct. When you start seeing these switch over, you're seeing a massive change in trend. So let's go and take a look at the S&P 500 sitting at all-time highs. As again, investors are super bullish and absolutely willing to overpay for U.S. equities. This is a phenomenon that I have trouble accepting, that people want and are willing to overpay for equities at levels that do not make any sense. But oftentimes, bull markets don't make any sense. If you were in the dot-com bubble or the housing bubble, and now in this equity bubble, people are willing to pay any price to be in the market, and they don't mind overpaying until they do. But stocks are up, and the trend is your friend. So no change on our picture there from a momentum standpoint. We see, on a price standpoint, momentum is slowing, but price is really dominant here. How about the NASDAQ? We see it now matching the S&P 500. The 3, 6, and 9-month are all clean, showing positive in the green, which I'll get to the point where we'll show you where one has been flipping around and not in a place where some people want to see it. NASDAQ, same story. It's above all its moving averages, right near all-time highs. Again, people are massively overpaying for tech stocks. It's just something that, people are cool with until they're not. No change there. How about the Russell 2000? This is the U.S. economy. People are massively bullish on, again, the U.S. economy at all levels. They think that sending people stimulus checks is really the way to fix the economy now, but not likely. But yet the belief is still there. Russell 2000, driving small cap prices beyond. If you look at what the economy has to do to get back, the Russell 2000 is telling you that the best we achieved in the last decade, we're going to ramp right through that, even though the economy is giving back 3 years worth of output. Industrial production is down to 2017 levels. And yet people remain super bullish on the U.S. economy. Somehow stimulus checks mean that everything's going to be okay. So far, it doesn't look like that. How about the energy sector now? If you were going to see inflation, if you were going to see economic growth, where's the one place you'd really want to see this? And that is in the XLE, the two largest stocks, Chevron, ExxonMobil, making about 45% of this ETF alone. Price still bearish on the two shorter term indicators, flipping bearish on the ultra long, and momentum is a mixed bag, bearish on a book ending this. Momentum still is clean in the green. Let's go and look at what we've got going on in the XLE. And you can see it's kind of rolling over and looking to head lower. Now, why does this matter? I mean, why does the XLE matter? Because it tells you what's really going on in the economy. And if you look at equity prices relative to energy prices, there is a relationship there. Now, it's not perfect. They're not going to be exactly correlated, but you can see right now the S&P 500 in purple is telling you the economy is massively rebounding, and the energy sector is telling you, no, it's not. And there's one of those is far more accurate than the other, and that is the energy sector. Because there is supply and demand components, people can be willing to overpay for equities, but ultimately, if they're traveling and driving vehicles and using energy, that is going to show up here. Now, from a bullish perspective here, you have a convergence of the 3 moving average. You have the 200-day flattening out, the 50-day rising, the 100-day, kind of flattish. You rally start with a cross of the 50-day and a reconfirmation. So perhaps XLE does tag the 50-day and go higher here. That would be a bullish confirmation. And you want to see repeated hits against the 50-day, but that would be one to look at. We're not there yet. So maybe this week, maybe next week, maybe not at all. Maybe the price will go sideways and the 50-day will catch up. That will work too. But right now, equity bulls desperately need some sort of confirmation from the broad economy to justify their risk-taking behavior. How about the financial sector? Interest rates still very low, and yet people are bullish on banks lending when banks aren't lending. When another thing that kind of baffles me, price bullish, momentum bullish, and you can see down here, everything is still nice and pretty on the XLF. And let's see, it's back near its highs set back in late 2019. It's back up here in these levels. And you have to wonder is, if the banks aren't really lending, what is the demand for equities here beyond the fact that we now know banks will be allowed to buy some of their stock back starting in the first quarter, which is going to be on Monday. So starting on Monday, banks will be able to do that. I believe it's already JP Morgan Chase has said they will. Now, what day it starts and how much they're going to buy, but they will be allowed by the Fed to buy their stocks back, and they're going to do it at massive price highs. Why are they going to do that? So the executives can cash out. So far, though, the market is telling us, hey, this is a bullish setup for the XLF and that banks are going to be super profitable. Well, hard to be profitable when you're not lending. How about utilities? And what are the banks expanding their balance sheet by the most? Mortgage-backed securities. They're buying bonds, not lending, buying bonds. How about the utility sector, which was once the hottest sector in the equity market, is now nearly all bearish. 3-month momentum, 6-month, 9-month, still in the green, but we should be watching for a flip on the 3-month coming soon. And here you can see the utility sector kind of languishing below its 50-day moving average, trying to fight higher, right into the support, right around $60 and change here. You can see this is where buyers have been at. And the reason I don't really spend a lot of time on utilities, you might as well just look at the Dow. It gives you the same scenario as this. But so far, the momentum is saying that utilities are likely to head lower, not higher. How about the industrial sector? I guess I goofed that up. This would be the Dow, not utility sector. Anyways, we'll move right on. No change here at all in the industrials. And let's take a quick look at XLI. Where are you? This thing is sitting right. Is this thing almost at its all-time high? Pretty much. So there you have it. You have industrial production has given back 3 years, meaning the industrial stocks should be trading somewhere down here in the $68, say $72 range. And investors think they're worth 88 plus. That's how you know you're in a bubble. When the economy is far lower than the equity prices, it tells you there's a problem. And the reality is the economy doesn't magically pick up 3 years of losses overnight. It takes years and years to get that production back. And the market says, no, we're going to get that back here in a matter of months or less. The market is going to be wrong about that. Let's move on to gold miners. Now, 3-month momentum just flipped green. It was red. When I just added this, it was red. Now it's green. This is not a good sign for gold miners. And short-term bearish, annual momentum now is switching back, on the short and mid-terms back to bullish here. Overall, no change. So what you're seeing here is gold miners are trying to fight for survival. They're trying to fight, and there's a reason that gold miners matter. Now, a lot of people are saying, well, there's been just tax loss selling, some other reasons why the gold miners just can't go up. And you can say, well, they're still in that bullish flag. Yeah, they still are kind of hanging out there. But here's the problem. They crossed the 50-day and have repeatedly tagged and failed at the 50-day, sitting below the 200-day. And this tells you, what the market thinks of gold mining stocks, a general, belief. When you look at this chart and look at what the market's telling you, it is bearish. Now, this is not good, because if you are bullish on the equity market, well, then you want gold mining stocks to go up, because there is a relationship. Now, it's not super tight, but usually, when you see stocks kind of rallying forward and gold mining stocks languishing and then starting to head lower, it tells you stocks are likely to head down. And that is dangerous. So what we're seeing here is gold mining stocks start to languish and, look at a very bearish picture against its moving averages, and it's telling you that the equity market is overcooked and very likely to see a correction coming. How soon? Don't know, but that is what it's telling you. How about emerging markets? This is another story for gold mining stocks. Emerging markets have been on fire due to a weakening dollar, because everybody thinks the dollar is going to nothing, even though that's not actually going to happen. But if you overlay gold mining stocks here to emerging markets, what you find out is there's a nice relationship between these two as well. And what it suggests is that as gold mining stocks head lower, because there is, again, a long-term relationship between these two securities, that you can't have both be right. So either emerging markets are right and are going to head higher because they are looking at breaking out near their all-time price highs, or gold mining stocks are telling emerging market stocks you're going to have a big move lower. And I have to kind of say that gold mining stocks are probably right at this level. That's kind of what my view is on that. Could be wrong, but that's kind of my view. How about the bond market? Of course, hey, we're the bond king here. And there's one thing we're interested in. It's TLT. Now, what you can't see here, because I do run these screens every day, but I give you kind of the average view on Sunday, because unless you're really running this every day and looking at it and understand how these signals work, what you can't see is this thing is starting to change. Now, some people said, well, when are you going to give up on bonds? When are you going to give up? Well, the momentum screens are telling you it's clean. Just because there's a price move down does not mean there's a problem. Let's take a look at what's going on with TLT, and you can see there's bottom right here. You can see the price is bottoming out. It's starting to move higher, and you can see the rate of this decline is slowing down. There's your momentum. So everything is telling you right now that this picture here is looking like a bottom and likely to head higher. It's rejecting against its 50-day, not a big surprise. It's made four attempts at the 50-day. Well, I guess I should say, since it started to bottom, it's only really made 2 attempts at the 50-day. It wasn't really bottoming here quite yet like we see this. So what we want to see for TLT is a move higher. I suspect by mid next week, we will see some of these momentum and price indicators start to turn green. That is what I'm seeing behind the scenes. But right now, a break through the 50-day would be constructive. And given the fact that there was no QE, during this whole period right here, none, it tells you that there is a demand for bonds. Moving on to high yield bonds. Speaking of more bonds, high yield bonds price remains bullish. Really only change here is on the ultra long-term picture. These short weeks, these holiday weeks, you don't usually get a lot of major shifts in the market. Let's see what's going on with high yield bonds, and they are sitting almost back near, not their all-time highs at all by any stretch of the imagination, but sitting back pretty close to their 2-year highs. Again, this, what baffles me about this is when we look at the data, the people are willing to take all this risk for a sub 5% yield. And there's a massive amount of risk in junk bonds. I mean, there's a reason they're called junk bonds to begin with, is they're the ones that are more likely to default when things go wrong. And given the state of the economy, it's hard to believe that that can happen, especially now that the Fed is banned from buying bonds, thanks to the expiration of the CARES Act and the recent stimulus bill. So for 5% yield, investors are taking an incredible amount of risk. How about gold? Momentum bearish across the board. No change on price. let's take a look at gold. Because remember, equity bulls, if you're bullish on the U.S. equity market and inflation, you really need to see gold get going. It's stuck right here at this resistance level of 1900. Support still remains between 18 to 1820, and it kind of gives you the impression that it doesn't have the momentum to speed through here. I mean, the momentum is telling you it doesn't have what it takes to speed through here. The question is, can price overcome this? All this resistance right here at 1900? You be the judge. Gold mining stocks tell you no. How about silver futures? No change here either. Let's take a quick look at what's going on in the silver market. Silver, where are you? There you are. And silver did get up. It's big resistance right here, overhead resistance sitting $26, $27 a share. Kind of mentioned that last week. This is really what silver has to break through to make anything happen. If it can't, then you're looking at a retest of support right down here in the $23 to $24, somewhere right in this range here. How can you tell? Look where prices are clustering. So you can see, even if you're new to technical analysis and you don't understand what you're looking at, this is where buyers and sellers were at, and they were duking it out. Some were selling, some were buying, and ultimately the sellers went out. And then down here, you see where prices have been clustering for a period of time. That's because buyers and sellers were duking it out. Buyers have won out up to where that previous battle zone was. Will they hold it? Couldn't tell you. Let's move on to the dollar. And this is a great picture of where you can see everything is red now. You've got any momentum is red, price is red, 3 months, 6 months, 9 months. What it's telling you is this thing is headed down. Now, what you want to see for a trend change is we want to see some of these momentum indicators start to switch back. And they, as you can see, they went from bullish to bearish last week. And there's some indicating, there's some early indicators that there's, is starting to change, but you can see the 3 months, 6 months, and 9 months. So what happens is what we want to see, if the dollar is going to turn around, and someday it will, whether it's next week or next year, or someday it will, we will want to see some of these momentum indicators start to turn green, and then eventually this 3 month will turn, and that will give you a pretty safe entry point when you start seeing these longer term momentum indicators flip over. Because what you're seeing with annual is something that's done a little bit differently. There's multiple ways to run momentum screens, and there's no reason I couldn't fit the 12-month over here to match these, but when it flips, I'll tell you. So in the meantime, what you see is a pretty bearish picture for the dollar. And is that indeed justified? Well, of course it is, because price has been down. But let's take a look from a technical perspective. It is just sitting right in solidly at this midpoint where it was in 2018. So in the first, say 4 or 5 months of 2018, it was stuck at, this was its midpoint. Here we are again. Can the dollar get down to this bottom point here where it was in the lower end of 2018? Absolutely, it can. There's no doubt about that it's possible. But it could also hold here. So we see everything is telling us this is not a trend change yet. It was almost here. We could see that, we saw the momentum trying to tell us, broke down. And now if you look at price, you can see it's trying to hold this level of support. Keep in mind, quantitative easing is actually dollar bullish. So with that, we will be back on Monday as usual for the macro show. Look forward to seeing you then. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by or selling security, financial instrument, or to say any particular trading strategies. We're West Bear by Steve Van Meter, personal capacity. Opinions expressed in the video that do not reflect the Atlas Financial Advisors Inc. or Steve Van Meter Financial. Probably the worst reading I've done in a long time.